Hello everyone, welcome to the latest edition of our Global Outlook here at the EIU. My name is John Ferguson, Director of Global Forecasting and Country Analysis. Today I'm joined by Pat Thacker, Regional Director for Middle East and Africa, and Felix Delbrook, Director for our Country Risk Service. Today, with Pat and Felix, we want to start with the US midterms and talk about what that means for the rest of the world, particularly Iran, South Africa, emerging markets as well. So we saw the midterms. There are lots of things we can talk about, but I guess we'll just focus on foreign policy for a minute. We expect, as an outcome of the midterms, we expect Donald Trump to, if it's possible, to actually escalate his sort of rhetoric and action in terms of foreign policy. And I guess there are probably a few reasons why we think that'll happen. The midterms turned out relatively as we expected. The Democrats took back the House, while the Republicans actually looks like they've increased their position in the Senate, which is broadly what we were thinking. But one of the important implications for that, for us, is where the Democrats have taken back the House, is that they now have so-called subpoena power. They can subpoena information from Trump, from Trump administration, and really exert a lot of pressure on Mr. Trump and the way his administration has conducted their business. So that will increase a lot of pressure on Mr. Trump. Secondly, as we've been talking about for a while, we do expect the Mueller investigation to reach its conclusion somewhere in the next 6 to 12 months. Again, that will increase a lot of pressure on Mr. Trump. And thirdly, as we've been discussing many times here, the US economy is slowing down. Put all those things together, and Mr. Trump domestically is going to be under a lot of pressure. So now, what does that mean for the rest of the world? As I said before, we expect him to escalate his rhetoric and his behaviour around the world. We've talked a lot here, which we won't cover again today, about the trade war. So the trade war is one area where we expect Mr. Trump to escalate. We do expect further tariffs on Chinese imports. So Mr. Trump will not be backing off in that area. But also Iran. We expect Iran to be a sort of a point of focus for the Trump administration going forward. Now, Pat, maybe I can bring you in here. The sanctions on Iran are now back in place after 2 rounds. What does this mean for Iran itself?
If you relate it back to Trump, what does it all mean after the midterm? I think the damage for Iran has been done. Full sanctions, including oil, have now come into place, particularly since the beginning of this month, November. The oil sanctions, the final one, and the most damaging for Iran, given its heavy dependency on oil, both for fiscal revenue, exports, and also engine of growth. Now, with the Europeans unlikely to take the sanctions-related risks for companies definitely would have US offices as well.
Right.
The Iranian economy is very much bedding down to the new order, going back to what it was 2 years ago, and very much re-engaging in a different way, looking east.
Right.
2 things they'll focus on. First, step up its efforts to limit the damage from the sanctions. One way is to go back to the barter deal, and you'll see a lot more of that taking place in the coming years, particularly with India and China. This is nothing new for Iran. Iran has lived under sanctions and had a very creative system going.
Right.
All right. So sourcing wherever they can, state-led financing from allies, and where possible, and trading in non-US currencies. There will be new friends. Old friends will become in new relationships as well. So from the US perspective, whatever Trump wanted to do has been done.
Right.
He stuck to his election promise there. Secondly, Iran will partially return to the resistance economy. Mm-hmm. What does that mean? Inward, homegrown products made in Iran for Iran. In order to shield the economy from external vulnerabilities as well and external pressures. This is nothing new, but however, there are different dynamics now in Iran as well, new challenges. The planned overhaul of the business regulations will still be on the table, but won't make much progress for obvious reasons, particularly seeing that the EU, particularly the European companies' investment will dry up in the coming years. And they were the big bonus that they were putting a lot of their weight on.
Right.
It will only be negligible effect with this 2-way process taking place. So what does it all mean on the political front? Rouhani's position will be further weakened. Just think back to how he came back into power in the last election. It was on the back of the UN sanctions being lifted.
Right.
Very much riding on that. Expectations had been raised. He's not been able to deliver now. What does it also mean? Hardliners who always resisted the New Deal, did mistrust the West, particularly the US, are now back in the driving seat, and you'll see their position strengthen. That can be bad news for Iran on the whole. You will see much more of an inward-looking regional presence will remain, particularly in Yemen, Lebanon, and Syria. So the wider regional influence won't change. Given his weakened position, Rouhani will constantly face new challenges in terms of the social instability, unable to deliver on jobs, and technically or untechnically, basically, Iran will go into further recession in the coming years. Right. Now, what does it also mean for the corruption? It gets deeper. You are really creating a stronger black market again. The barter deal will be interesting to see how it unfolds as well. We're no longer looking at China and India as they were 15, 20 years ago. Will they be willing to take the risks as well with the US? I would say it'd be a mixed bag there.
Do we expect... Does that pressure that you just spoke about, what does that mean for a possible new deal with the US? I mean, we expect Trump to take a harder line around the world. He has more room to manoeuvre in foreign policy. He'll be looking for some sort of wins or actions that boost his popularity at home or diverts attention away from things going on, as I mentioned at the start. The pressure that you've just talked about, the challenges on Rouhani and the Iranian economy in general, does that mean anything for potential negotiations with the US?
I would say the olive branch would have to come from Iran. The pressure would be from Iran. For Trump, what does it mean? Very little. He's actually going to be standing up and saying, I did what I wanted to do. And he has got allies in the region, Saudi Arabia, Israel, who are backing up the deal. Very much the new friends. Now, will Iran go back to the negotiating table? Perhaps in the future it will. Because the economic pressure is very real. It's not just for, are they coming? They're very much today, and they'll just keep rising.
Right. Felix, let me bring you in here, because of course Iran also matters for the oil markets. What does this mean for the oil markets and our oil price forecast?
Right. So, I mean, we could see the impact of this on oil prices when the US first pulled out of the nuclear deal back in May. Oil prices shot up from, something around $65 a barrel to something closer to $75 a barrel. So we saw a major oil spike then. Oil prices peaked well above $80 a barrel in October. So that gives you a sense of the kind of oil price impact of this. Yeah. Not just Iran. Of course, there's also been concerns around oil exports from places like Venezuela and Angola. But it's a big deal. Since then, of course, oil prices have gone in the other direction. They've tanked, and they're now back below $65 a barrel. There's two main reasons for that. One is growing concerns in the markets around global growth, which of course matters for oil demand, but also because the US has included or has introduced waivers,
and that was a surprise.
Well, it was a surprise, but it's consistent with what our overall view has been, which is that the sanctions would sharply reduce Iranian oil exports, but not completely eliminate them. So our forecasts for oil prices have assumed that Iranian oil exports would fall from above 2 million barrels a day to something closer to 1 million. So a sharp fall, but of a magnitude that OPEC can still cover with its spare capacity. So that's been absolutely crucial for our forecast. And it's been one of the reasons why we think that slow global growth and geopolitical risk will roughly offset each other in the next couple of years. So we've been expecting something fairly range-bound, around $70, $75 a barrel.
Absolutely.
So I think where we are currently is still consistent with that, but you are dealing with opposing forces, and of course there's big risks on either side.
Absolutely. Felix, you've also just mentioned the global slowdown. Can you just give us an update on what we expect for the global economy over the next couple of years because of some of these issues?
Sure. So, I mean, this year, of course, already we've seen more mixed growth across the world than maybe in 2017, with the US going gangbusters, but signs of slowdown elsewhere, particularly in China. But also in major economies like Europe. So conditions are already looking more mixed. And more recently we've seen rising concern in equity markets in particular around the future. So even in the US we've seen some really sharp sell-offs in equity prices in recent weeks. And that reflects rising concern that the global economy will slow in the next 2 years.
And possible concerns about the trade war finally catching up with investors around the world.
Yeah. So we share that concern. So we've been saying for a long time that we think global growth probably peaked in 2017.
Yes.
And we're going to see a more noticeable slowdown in 2019 and even in 2020. There's two main reasons for that. One is the trade war concerns. We don't think that the US will emerge unscathed from this. Of course, the Chinese tariffs still affect costs in the US.
Absolutely.
And there's been retaliation from China, not just in terms of retaliatory tariffs, but non-tariff actions, and we think that'll eat into profits.
Absolutely.
In the US.
And there's also the indirect effects of the trade war, the tariffs as well. It's not just the products and the goods that are targeted by the tariffs. It's the uncertainty it creates. It's the business uncertainty that it creates. So we do believe there's the direct economic impact of the tariffs, but also those indirect impacts also matter for the US economy as well.
Exactly, and you're starting to see that coming through in the equity markets, and we think that'll spread through to confidence more generally as we get into next year. So that's one of the reasons for slowing growth. The other one is much simpler. It's just that the US business cycle is now so far advanced.
It just can't run above. It's not going to run at 2.9%, 2.8% again.
It just can't keep going at this pace forever. Unemployment in the US, it's at the lowest level since the 1960s. So we really are now, it's safe to say that the US is at full employment, and we've kept waiting for that to show up in terms of faster wage growth.
And that's a few signs, a little bit.
And that's now, I think we can say now that that's here. It's still not super fast, but 3.1% wage growth in October, that's the fastest in 9 years.
Yeah.
So things are picking up. What does that mean altogether? It means higher costs on the domestic front as well as the foreign front for US businesses. And of course it strengthens the case for the US Fed, the central bank, to keep raising rates despite these trade war concerns. Another rate hike this year from the Fed, that's pretty much a done deal, and we think we'll see another 3 next year. So conditions are just becoming more challenging. Absolutely. And it'll show through in slower global growth.
I'm glad you mentioned the Fed, Felix. Can we just can I ask you to give us an update on what this all means for emerging markets outside of the trade war, which is now what we call our central forecast, particularly between the US and China? We've been talking for a long time here and also in our reports for clients about the risk of emerging markets, the risk of an emerging market sort of crash or slowdown. And everywhere I go and everywhere we go, clients are worried about this. We've started to see some contagion in the currency markets. But can you just give us an update about where we're at with that sort of broader emerging market story?
So the major challenge for emerging markets this year has been the combination of things like slowing Chinese growth and the trade war concerns with the US economy that was still going strong, and therefore you had that strong dollar story combined with more nervousness around emerging markets themselves, and that's been a very challenging combination. Broadly speaking, that's still where we are now. As we head into next year, we do expect some relief on the strong dollar front, as we see the US starting to slow. But the flip side of that, of course, is slower global growth. So I think the more challenging conditions for emerging markets, that's a story that's got further to run. Essentially, 2017 was a was a Goldilocks situation for
almost
emerging
a sweet
markets.
spot.
It was an absolute sweet spot. There was strong global growth. There wasn't a lot of fear in the markets, and global interest rates were still fairly low. And remember, we went through that period where the dollar was actually weakening. And a lot of countries took advantage of that to borrow a lot, and conditions were just very easy, and we're no longer in that world.
Yeah.
I guess the crucial assumption that we're still making is that while markets have become more discriminating on emerging markets, they've not turned against emerging markets as an asset class, and on our core forecast, we don't think that'll happen. Yeah. For a number of reasons, we're expecting stimulus to avoid a sharp landing, hard landing in China. And absolutely crucially, we think that those cost pressures that we've been talking about in the Western world, oil prices, wages, will remain contained, and so therefore the Fed is going to start to ease off that tightening bias next year.
Right.
That's going to be absolutely crucial. But if we're right about that, then I think markets will continue to focus on the worst performers, the most vulnerable countries, rather than becoming more pessimistic across the board.
Absolutely. So it does feel like, at least in terms of our central forecast, that the global economy needs to walk a fine line, but we think it will walk a fine line between the strong dollar, interest rate hikes, and so on. So
it's definitely something we'll continue to watch.
Absolutely. And just, we think we have about a 30% probability on sort of a wider emerging market crisis, which for us is not our central forecast, but it does mean it's something that is on our radar and something that we have to continue to watch.
It's a significant risk.
Pat, can I just bring you back in here? So one of the things we're talking about with our clients and our reports is that not every emerging market is the same. You know, Turkey is different to Argentina, Argentina is different to South Africa. They all have their own stories and their own vulnerabilities, but South Africa doesn't seem as vulnerable, although some people, you know, put it in some of these categories, these vulnerable categories about emerging markets, but I guess it's not quite in the same position as Turkey or Argentina. But can you just give us a bit of an update on how South Africa is performing? How are these issues of higher US interest rates and trade wars, and how is South Africa sort of
I think
through
South
this?
Africa is the one country in sub-Saharan Africa which is, of course, the major market, but also the one that's uniquely one that's globally integrated. So if the world gets a cold, South Africa will get pneumonia eventually. It'll take a bit of time, but it will get it. And I don't think it's any different in its own way from other emerging markets. It does feel any current swabble in commodity prices. For South Africa, when you look at it, what's in store? The installation of Cyril Ramaphosa, a very positive element that took place earlier this year as president when Zuma was removed from office, alongside his reformist agenda, has been the most positive element that's taken place in recent times for South Africa as a country, but also the future of the political future of the ANC party. Elections next year, middle of next year, quite important elections, and so far we're saying Cyril Ramaphosa and the ANC will just about make it with a small majority. What does that mean? Not out of the woods.
So has that positivity led to positive economic outcomes yet?
Not this year, because we're trying to put right 8 years of poor policy, deep-rooted corruption,
very high
unemployment, particularly with the youth, and poor growth. So the party was not happening for this emerging market in the last 8 years when other emerging markets were doing pretty well. So what does South Africa do? What it will have to do is not take its foot off the accelerator for policy reform. For the coming years, I would say it will take a full generation and strong policy commitment and political commitment from the top to engineer the change that's needed. Creating jobs, absolutely crucial. Business-friendly environment, very crucial, and underlining political stability and certainty. Those are big challenges for Cyril Ramaphosa and ANC as a party as well. And I think Felix mentioned the slowdown in China's growth, so the global headwinds will be playing against it as well. So there's not only the domestic challenges, but on top of that, it'll have to deal with the global climate as well.
Absolutely.
And already the US-China trade war is having an impact on the car industry. which is a major area for both employment and all the manufacturing, overall manufacturing output. So South Africa it's positive, having Cyril at the top, businessman, knows what needs to be done, has the confidence of the private sector, also the overall population, but he's really got to win that election next year, stay on course what's needed to get South Africa back on the permanent growth path and creating jobs. And you talked about Rand, the emerging markets, currencies coming under some pressure from time to time. The Rand will be no different, definitely, both from the domestic pressure and external in the coming years.
Excellent. Thanks, Pat. Let me quickly draw you out to the wider Africa region. I was in Dubai last week talking to clients and businesses out there, and there's obviously a range of conversations and challenges that people are facing out there. But one area of optimism, at least hopeful questioning, was the opportunities in Africa. It was really interesting to hear people talk about the opportunities that they see there in Africa. So just for people looking at Africa who maybe are not there yet or only just dipping their toes in the water, what are the things for 2019 that they should keep an eye out for?
Okay, it's a good point, and I'm glad that you covered it in Dubai, because Dubai is increasing its footprint in sub-Saharan Africa. Final emerging region from the global perspective. This is the final frontier. Mixed bag next year. South Africa, we talked a little bit about it. It'll be positive growth, but nothing to write home about.
Right.
It won't be spectacular. The big boys in sub-Saharan Africa, Nigeria, Angola, South Africa, Cote d'Ivoire, Kenya, all going through different issues at the moment. Out of all the big economies, from the East Africa perspective, it would be Kenya, which is the strongest growth. And that is the big boy there, and it will remain the same. Next year, Nigeria's got the big elections, the highly uncertain contested elections there. Assuming it goes okay, Nigeria can look forward to going back on the engine of growth, which has been another disappointing area there. Not out of the woods there as well. You've got the Boko Haram, the security issue, all of that. Angola, very much still adjusting to the weak oil prices, change of the presidency at the top. Don't expect too much change there in the next 5 years. Certainly you'll see things moving in a better condition, but nothing spectacular. It is the tier 2 markets I would advise the clients to look at, seriously look at. The medium and smaller economies. Look at Ethiopia, look at Senegal, look at the Central African countries again, some of the West Africans, Ghana. So those are the key tier 2 markets, which are the great opportunities. They're not the largest economies, but nevertheless they're the ones that you can look for.
Interesting, very interesting. Thank you, Pat. I think the key takeaway for me there is that people need to be informed. What better way to be informed? Be a client of the EIU. So as I've mentioned at other times, clients can access more of our reports for Africa, Sub-Saharan Africa and the Middle East, of course, direct people to our country risk service that Felix looks after. But if you're not a client, we also do have free analysis pieces and that sort of thing around there as well. But I'd direct all of you for more information to read more of this analysis from people like Pat and Felix, head to eiu.com. But thank you, Pat. Thank you, Felix, for another great conversation. We'll be back next month with another update of our global outlook.